All right, Mr. Francie, the time has come in exactly 9 days from the recording of this show, which is happening right here, right now. Statistics Canada will come out and release what happened in Q4 of 2023 and with GDP. What do you think is going to happen? This is an official Patrick prediction I'm asking for. Where do you think it's at, Patrick? Positive, negative, zero? Where are we going?
Well, I think we're going to be in that zero and slightly negative, maybe. I think that what's going to start to happen, we're going to see a couple things happen. Number one, the lag is finally starting to catch up, and I think we're going to be in that zero, maybe slightly negative. I'm thinking more around zero range. And I also think we're going to see another uptick in unemployment. So that's lag catching up.
Ladies and gentlemen, you heard it here first. Patrick prediction: if we do end up with a negative GDP in Q4 of 2023, that means we will officially be in a recession in Canada, and that's only one of the topics we're covering on today's show. We're also covering interest rates, we're covering inflation, we're covering housing supply, and we're covering short-term rentals. It's going to be a great show. Strap in, get ready. Patrick, let's get into it.
Let's do it. Welcome to Rein It In, episode number 33. Remember, like, share, subscribe, put it in the comments what you like about the show, even what you don't like about the show. Let us know. Let's get those algorithms going.
All right, Patrick, let's dig in a little deeper into that first conversation about GDP. Your GDP forecast is that we're going to be negative, zero, or slightly negative, and that's a bit of a hedge there. I kind of feel like forcing you to take a side, but I'll give it to you for today. So you're saying zero, slightly negative, and there's a lot of data showing this. I'll give you my prediction, which is I think that actually you're going to have a surprise on the upside. I don't think we're going to go into official territory of a recession, which means we're going to be slightly above zero. Doesn't mean we're going to be like doing 2% or nothing crazy like that. I think we're going to be slightly above zero, but I do think Q1 of 2024, you'll get a negative GDP signal. That's what I think, because I agree with you on the lag. So anyways, I'm just giving you the JG prediction because, you know me, I got to balance out the Patrick predictions.
Okay, well, that's fine. But I'm going to rain on your parade just a little bit. And probably we're both right to some degree. But the one thing that we have to always go back to is that it's regional, not national. And every province will probably be in that zero or slightly negative, except for Alberta. And I know you're going to love that comment because it's just what it is. And it's not national, it's regional.
Okay. Yes, we'll get into the different regions as we get into the show. But I think one of the things that's interesting about this, Patrick, and often I do want to remind people of this, especially during these kinds of economic times. One of the things you will constantly see is they put out a statement. Here's the GDP. And then months later, they revise it. They actually did this in July of this year, Patrick, where it was negative GDP, and then they revised it up. Because if that would have stayed negative in Q2 of 2023, and then Q3 of 2023, we know was negative, we would have already been in a recession, technical recession. Now, a lot of people are already arguing we're in a recession regardless. And there's actually a narrative out there of what's called a rolling recession, where kind of a recession is going through all the different industries. And that's kind of an interesting narrative as well, Patrick. So fun fact is I'm just saying that oftentimes the StatsCan comes out with their numbers and then they revise those numbers. So don't be surprised if they come out with either a negative GDP and then a month later they revise it to zero or revise it up a little bit, whatever the case may be. It happens all the time is my point, Patrick.
Well, I think that you hit on a couple of really key points, not the least of which is that when you look at the different industries, many industries are struggling, others are not struggling. And that's the differentiation right there, is that it is in some regions right now, you're thinking if you're in a particular industry, you're feeling like it's a recession. Now, let's consider when you're in the real estate industry, for example, if you're a realtor, you're saying this is a recession as a realtor. I mean, the number of realtors that have quit, for example, being realtors and are out looking for other jobs in the Toronto GTA region overall is, kind of epic in terms of the spike. But I want to go back to one thing here, JG, which is what are we talking about all this stuff for? When we look at the housing industry overall, it's really nothing has been happening. It's the same story. right now it's now into month after month, not enough inventory, prices aren't coming down, although they're coming down in some regions off of peaks. It's not like they have this huge crash that everybody's been talking about. And so when you look at housing, it's like much ado about nothing. It's the same story. Now we have to look at what's economically happening so that we can say, okay, well, where is real estate going? What's going to happen into the future as we kind of chug away? It's a pretty boring real estate market right now. But from an investor point of view, we have to keep focused on the economics so that we can make decisions as to what we're going to do in the real estate world.
Well, and that's what I was going to say, Patrick, is funny enough, is for many it's boring, but it's actually really not boring, because this is where kind of the things really start to shape, and investors that have their nose to the grindstone and that are in the market will make some very significant moves as the economy starts to move into the next phase of the cycle that it's going through. But I want to point this out, Patrick, and it's this chart here I'm putting on the screen, which is Oxford Economics, which is an economics company we follow quite closely. They believe that the Bank of Canada has been overestimating the economy's strengths, and they are predicting. Actually, the Bank of Canada predicted essentially a 0% Q4 2023, 0% GDP. They're also expecting 0% GDP in Q1 of 2024, whereas Oxford Economics is expecting a contraction of 0.3% in Q4 and 0.4% in Q1. Interesting who is going to be actually right, because soon we're going to have these numbers.
Well, I heard economists the other day, well, not quite an economist, but somebody who's in the world of looking at what's happening economically across the country and into the US as well. And his comment was very interesting. He says, if you really want to know what's going on with the economy, go look out your window. And I think that was an interesting point that they made, because when you look at, and we've seen some of these charts, JG, when we look at the different income levels, if you're in a certain income level, you're in a recession, you're struggling, you're trying to make ends meet, you're pairing up, you're moving back home with family, or you're bringing roommates in to be able to afford to live. When we look at the cost of living, it's up. So if you're in certain income level, yeah, it's a big challenge. And we can't deny what's happening in every city across this country, which is the degree of homelessness. Now, historically, that homelessness represented, mental health. It represented, well, it still does, but it was really about mental health. It was drug addiction and the crisis of opioids, for example. But what's happening today is that families are literally having to move onto the street into these tent cities, and they're going to work. They're actually got jobs, but they can't afford a place to live. So if you're part of that cohort, that particular demographic, that income level, yeah, you're in the middle of a recession. Some would argue a depression. So look out the window and you start to say, well, something, there's some real challenges going on out in the world today.
Now, why are we talking about GDP is important, Patrick? Because some people are listening to this thinking, what does GDP have to do with anything? Well, folks, as you know, many of you are attached to what's going to happen with interest rates. Are interest rates going to go up? Or interest rates going to go down? What's happening on the next interest rate announcement? Well, a lot of that's going to have to do with what happens with GDP. Is GDP going to be flat? Is it going to be negative? Or going to go into a recession? So on and so forth. And what's interesting, Patrick, is that, as you've pointed out, yes, off the peaks, and I'm talking the COVID crazy prices peak, prices have come down. But I also think that the Bank of Canada, as well as the rest of the economy, is starting to realize, listen, there's a floor to real estate, and we've hit that floor in many, 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 many markets here. There might be a few that are still going down. In fact, some markets, and the real estate sentiment is really starting to pick up. And what's interesting is now they're in a really tight bind, because they know if they lower interest rates, what's going to happen, Patrick, is that real estate is going to start to pick back up, which is going to be great for us investors on one hand. But on the other hand, they're afraid it's going to fuel more inflation, which we're going to talk about inflation next, because we've seen in this chart here that the real estate sentiment is really starting to pick back up, Patrick. So the point is that the Bank of Canada has been in a very difficult situation. They continue to be in a very difficult situation on what they're going to do with interest rates.
Well, it's interesting around market sentiment. We've talked about this before, and I actually can see where sentiment's going to shift again. We talk about interest rates, we get into that in a minute, but when you look at the number of people that believe there's going to be cuts in interest rates, people are front running. They're saying, okay, let's get into the market now before prices go up. I want to get in because interest rates are going to go down, and that means prices are going to go up, so I'm going to get in now. They're literally trying to front run the interest rate and the shift that they think is going to happen, which is interest rates coming down. I think we're going to be a little disappointed in that area.
Oh,
Interesting. We'll talk about that next with interest rates and where you think they're going. Another Patrick prediction. My gosh, that's two Patrick predictions in a single show. I'm so excited. But interesting what you're saying, Patrick, about front running the market, because I got a call recently, as you know, and I've said on this show before, I had a property I put up for sale in November, which according to this chart of the real estate sentiment was the low point of real estate sentiment. Boy, I couldn't have timed that any worse. But the point is that I took that off the market mid-January and I rented it out. I said, you know what, I need to create a little breathing space. We always advocate real estate investors have a second and third and a fourth exit option. Our exit option was, listen, let's just take a break. Let's just put it on the market. Let's rent it out short term. And then we'll come back and we'll sell it when the market improves. So that's exactly what we did. And we got a great tenant in there until June of this year. What's interesting though, Patrick, my property wasn't even off the market 4 weeks. I got a call on Friday that people want to see it. It's not even on the market, but there's so little inventory on the market that some people are calling and saying, listen, could we see that property? We know it was on the market. We know you took it off the market. We'd like to see it.
I would like to see it.
And that's pretty fascinating, Patrick, because I got to say that's never happened to me before, where there's such short supply on the market that people are actually going around looking at properties that are not even on the market anymore. And it's interesting. These people are so serious that I'm told they're going to be submitting an offer, which is pretty cool.
Well, good luck with that one, and we'll see where it all goes. But it is a very interesting time in that regard when it comes to the supply side of the equation. Just not enough to go around.
Okay, let's talk about your predictions with interest rates. And Patrick, where do you think it's going to go, buddy? Tell me, where's it happening?
Well, something it is interesting, isn't it? Because when we look at where and what it is that the Bank of Canada is trying to do, and everybody's looking for a answer. What is the cause and what is behind it all? When we look at an economy, it's so nuanced. There's so many different things. Many have forecasted when we look at certain aspects of bond yields, and they've actually kind of worked in rate decreases into, first it was early into 2024, as in the first half of 2024. Now it's the back half of 2024. I'm looking at it and I'm going, something, I just don't see them lowering rates very much before the end of 2024. There's a part of me that's going, I don't know. And this is just my opinion, of course. Nobody knows where the hell rates are going. But if I'm looking at it, I'm going, I don't think they're going to drop rates. I think that the economy, from their perspective, they're going to be late in terms of, do I think they should lower them? Yes. Do I think they're going to? I don't think so, because the Bank of Canada has a tendency historically of being late. And what hasn't showed up yet is the unemployment. And I still think that we're going to see another uptick in unemployment. And until we start to see that uptick in unemployment, I think the Bank of Canada is not going to get in front of it, and they're going to react to it as opposed to being proactive on it. And they're not going to lower rates much. I think we'll be lucky if we get a quarter point by the end of 2024. That's just my view, and I hope I'm wrong.
So do I. Actually, everybody, folks, you're listening to this, please put a comment in there and tell Patrick that you hope he's wrong. Please put a comment in there, at least for my sake. Let's just get the energetic gods on our side here and hope Patrick is wrong in his Patrick prediction.
Listen, I'm hoping I'm wrong. I've got mortgages too, lots of them. So I'm hoping I'm wrong.
Now, have a look, folks. I'm going to put up on the screen right now. These dates are the interest rate announcement dates. And you can see here, March 6th is the next announcement by the Bank of Canada. Any date that has a star beside it, that's when they do a monetary policy report. So that's essentially when they start to tune up their monetary policy. And I think, in my opinion, Patrick, they seem to make bigger moves around the dates with the stars. That's because they are adjusting for the future. So March 6th, because in January 24th they specifically said they plan to hold, essentially is what they said. They were just kind of holding firm for now. I don't see any big changes in March 6th. But on the next show, we will be just before, I believe we are shooting the next Rein It In show on March 5th. So we're going to be right on the cusp of this announcement.
Again, I think that things are just going to stay status quo for the first half of this year. I don't think we're going to see much in any way until we start to see something unfold differently in the real estate market. And we're going to talk about short-term rentals, but the bank, or sorry, the our federal government believes that these, and our provincial governments believe that the changes that they made in short-term rentals are going to shift what happens in the real estate market. We're going to find out. That won't happen quickly either.
Lots coming up, folks, on GDP, interest rates. It's going to be an exciting show. So we're going to stay, really tuned in and see what's going on.
Let's add a comment right here, and that is, JG, if investors just keep chugging away, there's deals out there. Don't stay on the sidelines and ignore what's happening in real estate, because we do know that many are finding deals. They're staying engaged. They're not necessarily buying, like chasing deals, but they're watching for the opportunities as the opportunities are starting to show up. The point is, don't disconnect from what's happening in the real estate market. You're going to miss some great deals.
All right, Patrick, next topic of conversation is inflation. Where are we at with inflation? And I got to say, from a headline perspective, it's starting to look better and better because CPI has dipped to 2.9% from 3.4%. But the best part, and I'm going to just fuel your fire here, is if you take out shelter, we're not at 2.9, we're actually at 2.4, which is in the range that the Bank of Canada wants to see it. That's exciting because this might mean
some interest rate drops. Let's hope. Maybe, maybe not. What do you think?
Well, I think again is that, number one, it's 2.4, 2.9, depending on how you want to do the math. It's encouraging, and I'll be looking forward to listening to our federal government talk about how amazing they are at controlling inflation. But I always want to come back to one fundamental thing, which is inflation isn't coming down, it's slowed down. So instead of saying it's 3.4%, it's 2.9.
that's all they wanted. That's all. That's what the Bank of Canada wanted. They're not looking for deflation. That would, in their world. Now you and I have different opinions, maybe, but in their world, deflation, which would mean the price of stuff is actually coming down. They would not like that. The Bank of Canada, they would react to that very, very negatively.
Well, I think there's a couple things around it, and I'm on record, and I'll continue to say it. Is that interest rates have a limited impact on certain aspects of what's going on economically. So as much as we think, well, keep increasing interest rates or lower interest rates, that's going to have a big impact on inflation. And while that's true, I think there is a much bigger correlation between oil prices and inflation. And we have to watch oil prices. And if oil prices continue to kind of go up, they've spiked up a little bit. They're in that $80 range, which is up from 72, 68. So we're starting to see that. So I think we're going to see an uptick again in inflation, and that's going to be based on oil prices. Now, I hope oil prices don't go up, but I just can't see it not going up given what's going on with the rest of the world and the wars that are happening or potentially happening. And it is a fight for oil. Ultimately, everybody thinks it's something else. Oil makes the world go round. That's kind of what we're going to be at the effect of.
Interesting. I know we've debated, this conversation many, many times, but just so everybody knows, they are stating that the reason that the inflation rate is down, which by the way went from 4.7% in December to 3.4% in January. It's moving in the right direction. There's no doubt about it, especially when compared to last year, which is what they are concerned about. Whether that's right or wrong, it doesn't matter in this conversation. What matters is that's what they're concerned about. And they're stating two things, Patrick, which is lower gasoline prices and lower grocery costs. Those are the two things that are driving things down, which is interesting. Now, what I find fascinating, and I kind of hope this doesn't happen, but I was kind of hoping, in a sense, that in order to get inflation under their target, which is they want inflation at 2%, right? That's what they want. We know that 0.5% from 2.4 to 2.9 is shelter costs, which is largely attributable to rent, which is largely attributable to interest rates. So that means they can get it from 2.4%. They can get it from 2.9 to 2.4 if they started lowering interest rates. That's what essentially that means, right, Patrick? So I'm kind of curious to see if they're going to take the opportunity of that last little bit, getting it right to their target by starting to lower interest rates. And I know it's a very difficult dance they have to kind of do, but fascinating that opportunity is there for them.
Well, I think, we have to go back to a couple things, so I want to reconnect back to the oil price. I want people to really pay attention to those oil prices. So we're seeing gas prices come down. That's lag. Remember, I just said as oil prices had come back down a little bit, and then there's the lag. So gas prices come down, hence transportation costs come down, operation costs for farming. And so then we see the lag of some prices coming down. If oil prices go up, and now we see that oil prices have kind of bumped into that $80 range, I think that we're going to see the same lag again. So then we're going to see prices go back up. That's the first part. Second part is we heard Powell with the US Fed say that they're not waiting to lower rates until things get to 2%, their target rate. They may lower rates even if it is at 3.4% or at 3%. They have to look at what's going on economically. And this is how I believe the Bank of Canada is also viewing it, as Tiff actually said similar things. So it's not like,
okay, we got to get to 2% before we lower rates.
No, we have to look at what's going on overall economically. And I think when we start to see the job numbers start to increase again, I think they're going to start to then consider bringing those rates back down. But I don't know when that's going to happen. I just don't, like I say, there's parts of the economy that are really quite slow, but there's other parts that aren't. And so I just don't see them rushing to lower rates like what was originally forecast when we looked at the different banks and the different economists saying, okay, at one point, JG, they were talking about 6 decreases in 2024. And now it was at 4, and now they're thinking 2, and I'm thinking none. So who knows?
Patrick, let's reconnect us to the beginning of this. You and I never thought it would get this bad. You and I never thought they would go up this much. In fact, you and I and many people, many experts across, were saying it'll never go up this high. And that's because of all the debt that the governments have and so on. So everyone had their own theories about it. Point is, we're all friggin' wrong, every single one of us, because it did go that high. And I'm not quite surprised that we're wrong on the way back down, too.
Well, we just never anticipated the willingness of our government to go as much into debt, as run as big a deficits. Nobody anticipated the degree to which they would kick these cans down the road. And here we are today.
Now, Patrick, you sent in this great chart on oil prices and the U.S. inflation rate. You want to take us through this?
Well, I think it just really is showing that as goes oil, so goes inflation. We make so much about interest rates, and I've said this for the past 3 years now, is like we have to connect to what's happening, in the world when it comes to oil. Oil drives everything, and to think it doesn't, or to think it's something else, would be really naive at the end of the day. And this chart happens to show that when you see the shift in oil prices, you see the shift in inflation, and that's not profound. It's just that if you pay attention to it, you realize that everything's connected to the cost of oil because of manufacturing, because of transportation costs. And ultimately, that all gets passed on. JG, it's no different than rents. We see increasing in rents. Everybody talks about supply and demand. Yes, but what's a big component of rents? Well, it's the cost of carrying that particular property. So we see rents go up because interest rates have gone up. So like interest rates, oil is kind of like that too. When we see oil go up, the cost of everything has to go up to compensate for that adjustment in what it costs to manufacture, what it costs to transport on the surface.
There's no doubt, Patrick. Listen, when it comes to economics, if you look at the largest input factors, when the price of those input factors goes up, it drives the rest of the outputs. And oil is a massive input in many, many, many things across manufacturing, across transportation. And because transportation impacts the rest of the segments, it does impact absolutely everything. When it comes to real estate, you're absolutely right, Patrick. one of the largest input costs is debt. It is by far the largest input cost, and interest rates drive debt. And as a result, that drives the output called rents, which we'll talk about next. But it is fascinating, Patrick. And as inflation comes back down into where the Bank of Canada and the Bank of, the U.S. Fed and where the rest of them want to see their numbers, it's going to be interesting to see how they impact interest rates, because that's going to kind of drive the rest of the economy. So more on that as we continue to watch closely at what's going to happen with inflation.
Well, I think you got, and I want to just shine a light on this, for listeners, is when we look at what's happening with oil prices. It used to be, the man with the gold. What was it? Gold. The man with the gold rules, or all the gold rules. It really isn't that. It is the guys with all the oil rule. And when we look at now BRICS, the BRICS nations are now supplying 60% of the oil to the world. It's taken over the shift of the petrodollar. The U.S. is not the powerhouse they were, although they're still a big deal in the oil production world. It's shifting. And this is where I think we're going to start to see things over the course of the next year or two. We're going to see some pretty dramatic shifts in and around oil because of what's happening with BRICS versus US.
You know what? No problem. The U.S. has this little thing called an election coming up. That's not going to impact anything. We'll worry about that later.
Yeah. Nothing. Oh, by the way, this is an interesting stat. I think it is 60%, I don't know what the number is, 60% of the major countries in the world are have an election in 2024. How's that?
Wow, nothing crazy is going to happen in 2025 then. Is that what you're saying, Patrick?
Oh, it's all cool.
All cool in the hood. Awesome. All right, Patrick, let's talk next about housing supply, which is always a key conversation for you and I at the Real Estate Investment Network, as well as with any investor we're speaking to. And that's because at the end of the day, especially in Canada, this is what drives most things that happens in housing. And this is actually the housing supply and the lack thereof, which we'll speak to in a second, is actually what has created this massive floor on the real estate prices, which everyone is kind of starting to feel like, okay, prices did come down off their peak, but they hit a floor. They will not continue to go lower. That's because we just don't have a whole lot of housing, enough housing. We know that. You and I have said that from stage many, many, many times. And when you combine this lack of housing supply with this crazy population growth we've been having, the market will continue to go in the natural direction it wants to go, which is we have a supply crunch and a big demand on the other side called population. And that typically over time brings prices up. There's no doubt about it. It's just right now we've been artificially keeping prices down with interest rates, but that is going to eventually stop, in my opinion.
Well, there's so many arguments around all of this and so much controversy around the topic of supply and demand, and there's more than enough supply and demand isn't what it is. And, there's so much controversy around it, but we have to look at what we see right now. And ultimately, we don't see enough supply. People aren't selling their house because they don't want to go into the interest rate. Who would have thought, that at the time, in anticipation of people just going,
no, I can't sell even though I want to because I can't afford or I can't justify the increase in cost.
Number one, of the house that I have to buy, but number two, the cost of carrying that house. You actually aren't even able to, in a middle class mentality, in a retail front facing mentality, you want to upgrade. Most people want to upgrade unless they're being transferred or they're shifting jobs, etc. But ultimately they can't. So in other words, because of the cost of interest rates or the cost of a mortgage payment, they can't buy a $2 million home. So they're not upgrading anymore. So they're buying for the same mortgage payment, they're going to buy a less house than they actually own today. So it's really messed up the whole market, which goes back, and we're going to do a show on it, which is there is a strong thesis around if interest rates go down, JG, guess what? Supply picks up, the competitiveness in the supply, because all of a sudden there's more housing available. House prices actually come down based on rates going down. We're going to do a show on that, and it's really fascinating in that concept and that theory of how that works. And by the way, it's proven out over a number of countries over the years. Interest rates come down, so do housing prices because of the shift of supply. How's that?
Now, that is interesting. I can't wait to do that show because I'm not convinced yet. And now you're still trying to convince me of this. We'll see. I got to see the stats. I got to see the data. we'll see how that goes. But what's fascinating here, and for people listening, there's really multiple factors happening at the same time here, which is by the Bank of Canada increasing interest rates as high as they did, as fast as they have. It has done, yeah, yes, there's no doubt the price of real estate has come down from its highs. There's no doubt about that. It definitely impacted that for sure, 100%. But it also had a couple other impacts, Patrick. And the first thing is that a lot of projects have been put on hold. A lot of building projects have been paused, canceled, and that only hurts future housing supply. So the housing supply crunch we were in, because you and I have showed a lot of data over the years, we were in a housing supply crunch. We are now even worse than we've ever been from a housing supply crunch. And this is just one data point, one chart showing that. I mean, look at the deficit here. It's literally just about off the charts. We had to make the chart bigger to accommodate how off the charts we are now in terms of housing supply deficit.
100%. And we have to look at, number one, I'm going to keep always going back. We have to look regionally. So for investors, you have to look at regionally what's happening, number one. Number two, you have to consider property types. So right now, when you look at what's happening in Toronto / the GTA, we see a little bit of a spike in the number of condos on the market. But to your point, builders, developers have quit. So then what's going to happen is that lag is going to catch up, and there's going to be a future shortage of those condo market within that condo market. And so it's interesting to kind of break things down. What people aren't taking into consideration is the lag effect. And we're also, and this is one of the reasons that I'm suggesting that we're going to see an uptick in unemployment, because these developers, builders have quit. They've tapped the brake, which means within the construction industry, things are slowing down. We've talked about that. You're seeing it in your own business where you're starting to see the availability of labor because people aren't as busy. Guys want to get to work. They need to get back to work, and things have slowed down. So the demand of that labor isn't as high as it was. All to say that, again, supply is an issue. It's going to continue to be an issue. And it's interesting when people tap the brake, developers, it just gets worse.
But interestingly, for real estate investors, if you're watching this, think about this is not a bad thing for you, by the way. This is the way I've always seen this, Patrick, and I've known this narrative since the day I began investing in real estate. I view this as my insurance policy. You know, Warren Buffett often says that you need to invest in a business that has a really strong competitive moat. This, in my opinion, is our competitive moat as investors. It just makes they're constantly making it more difficult to get into real estate. The housing supply is going down, not up. The incoming number of people, we have a great chart here on population growth, is going up, not down. And when you have a market where you have a strong competitive moat, it's difficult to get into. It's more difficult than it's ever been to get into real estate. And you have this a period where now supply is going down, demand, i.e. population's going up. That's nothing but a good environment for real estate investors. Given that right now a lot of people don't feel that way, this is just creating this slingshot effect I've been speaking about for the last year, and it's being artificially suppressed because of interest rates. That will, and I think that's the next challenge of the Bank of Canada. They know that's their challenge, which is they're going to try to unload that slingshot without having a massive boom again in the real estate market. That's what I think is really happening here.
Yeah, it's interesting that with all of this, I quite frankly, I see it all as quite fascinating. But, this goes back to, I hate to use the term, but it's a little bit of a real estate great reset. It wasn't that long ago that
Did you just really say that? Did you just really use those words?
I did. But it goes back to a fundamental, JG. And this is, for the REIN community, for those who remain educated, a little bit more sophisticated in their real estate investing strategies and how they view real estate, it is harder work. Not everybody's a real estate, genius right now. It was only a couple of years ago that everybody was a genius. Everybody was investing in real estate. And what has it done is it's kind of taken out all of the those individuals who weren't ready to actually play the game, treat it like a business rather than just, okay, I'm going to throw some money into the pot, see how it all turns out. Those individuals right now are fighting fires because they were buying the wrong property, the wrong pre-construction deal. They were just looking at it going, real estate only goes up. Look how smart I am. For the more sophisticated investors within, let's say, the REIN community, you were following strategies. You were actually treating it like a business, and you weren't making some of those fundamental mistakes that new investors who thought they were geniuses, who didn't have the education, who weren't looking at the data, who were making emotional decisions. That kind of cleaned up that group of individuals. So I think right now, as we get into it as investors, this is where some opportunity continues to live if you've got the education and you're in the right community, like Rain.
Yeah, absolutely. No doubt about it. And the output, just so everybody knows, the output of high supply, low supply, high population, lots of demand, and the difficult interest rate environment we're in, the output of that every single time this will happen, Patrick, is rising rents. And my gosh, rents have been on an absolute tear across the country, in some places more than others, but they really have gone up. In 2022, they went up significantly. In 2023, they went up across the board, just about across the board, other than Ottawa, across the board. They went up more in 2023 than they did in 2022. And you can see this just continues. And even if you go back, and this is a GTA chart here of rent growth all the way back to 2014, you can see 2023, the biggest growth year on record, 8.7% across, and vacancy has done the exact opposite. Naturally, vacancy is negatively correlated, and vacancy has just fallen off an absolute cliff everywhere. And in fact, in many markets now, we are sub 1%, like Vancouver, 0.9%. But just about across the entire country, Patrick, you're sub 2% in terms of vacancy, which all of this is great for real estate investors. It means you have a lineup of people called your clients looking to rent your product called your apartment. And all of this is good things for real estate investors.
Well, again, what are we trying to do? We're trying to stay ahead of inflation. There's a strong argument, for ongoing inflation. Some would even say there's going to be a hyperinflation, period of time. So all of that aside, what are we trying to do? Put our capital to work to stay ahead of inflation. Everything that we're showing here when it comes to real estate, increasing rents, ultimately speaks to what? The growth in real estate because of inflation. It just goes forward at the rate of inflation or ahead of the rate of inflation. JG, we've been talking about this, certainly pre-pandemic, but since the pandemic, this was not rocket science. You could see how rents were going to increase, how they had to increase, and we've been talking a lot about that. Did we shake out all of the less sophisticated investors right now? Yeah, because interest rates are higher. It's tougher to get a mortgage. Banks are more, discretionary in terms of who they're lending to and how they're lending. But ultimately, the game stays the same. Keep investing, keep putting your capital to work, and you'll do well.
And the headlines are just, and by the way, folks, you're going to see a lot of headlines about rents going forward. I think this is going to become a critical element. The closer, I believe, Patrick, the closer we get to the election, and the Canadian election, not the US election, but the closer we get to that, and we're getting closer and closer. It's not close enough in my opinion, but anyways, that's beyond that. Is as we get closer, you're going to start to see more and more headlines about rents, more and more headlines about home ownership, and it is going to become an absolute, it's going to be one of the largest election issues, I think, of the next election.
Yeah, and the Liberal government is making some moves in behind the scenes right now, as is some provinces. So we're starting to see that happen. It's it's too little, too late, but they'll do what they do.
All right, Patrick, last topic of conversation for today is short-term rentals, because now, and you and I talked about this quite some time ago, but some of the provinces have really stuck their nose in the short-term rental market. Some of them are putting very hard stops to it. This is happening in British Columbia right now. You'll speak to that in a second. And if I rewind the clock, Patrick, it was not long ago that when COVID first happened, we talked about student rentals, and we talked about how people had to be very careful around the student rental market, and that we just, a lot of people buy real estate, and if they only have one option, like short-term rental or student rental, sometimes they still proceed with their real estate investment, even though they only have one exit option or one pool of candidates where that property becomes cash flow positive. That's very dangerous in our opinion, Patrick. And short-term rentals, after the student rental kind of cohort fell off during COVID, short-term rentals, which rebounded huge during COVID after the first kind of couple lockdowns and all that. Uh, Short-term rentals went off the charts, and in fact, they're still super, super strong. What's happened is now the governments, whether it's municipalities or provincial governments, have stuck their nose in there. We hate it when this happens. Let me say for myself, I hate it when the government sticks their nose in business affairs. But that being said, what's happening now is they're putting a hard stop to some of these short-term rentals, and you got owners that are going to lose their shirt because that property will not cash flow under any other circumstance other than short-term rental because of the high interest rates. People are panicking, Patrick.
Well, let's face it, you got some big challenges. So first off, the government looks at it and says, let's get rid of this short-term rental and then get these into the long-term rental pools. So in other words, they're trying to increase supply by shutting down short-term rentals. The challenge that they're going to face, and this is an interesting one, you're going to see, I think, in some regions where people are going to be forced to sell. You literally cannot get enough cash flow if you're renting out a unit that you did the budget around short-term rentals, where you're, let's say, going to generate $6,000 or $8,000 a month, and all of a sudden from a rental on a long term you're only going to get $3,000 or $4,000 a month. You're just not covering the load that particular property has. So first off, I think we're going to see that in some regions. I think you're going to see a spike in supply of people wanting to sell. They're not going to go to a long-term rental because it won't carry the cost of it, if you will. You've got a number of people who are into pre-built scenarios where they actually bought it based on the fact that they're going to do short-term rentals. And I'll use Kelowna as an example, tourist town. I think they have almost a couple million tourists come through that city. What the heck are they going to do? They don't have the hotels, number one, to accommodate. They don't have those rooms. A family of 5 is really hard pressed to come into any city and say, okay, we're going to rent rooms. Number one, there isn't that many rooms. Number two is that if you got that family of 5, generally you want to cook, you want to hang out as a family, you want it to be more home-like. So all of a sudden that's going to shift. I think that this, as things often are with government, they're not considering the unintended consequences. They're not really looking at it. So it is going to be messy. That comes into effect, by the way, May 1st, 2024. And I think we're going to see some real shifts in some markets where short-term rental, what are you going to do in Kelowna if you got nowhere to stay? What's that going to do to the tourist industry in Kelowna? Let's just say ripple effect, unintended consequences.
That's exactly, Patrick, what I wanted to talk about, which is the tourism industry. I mean, listen, these short-term rentals are popular because they're freaking awesome. That's the bottom line. They're not popular because they're so much cheaper. Like back in the day, yeah, they used to be so much cheaper than a hotel room, but a lot of these short-term rentals now are priced very similar to hotels. And it's not like hotels are starving. It's not like hotels are losing their shirt. All the good hotels are just slammed booked. I mean, you and I travel a ton, and like these things are just booked. So the point is the hotel industry is doing very, very well. If you run a good hotel, you have a good property, you're doing very, very well. And these short-term rentals are a fantastic option. And I think that the government or whoever is making these dumb decisions is not looking at what you just talked about, the unintended consequences. They're just trying to get votes by saying,
oh, listen, we're gonna ban these bad short-term rentals.
What about the gas people put in their cars? What about the restaurants? What about all the lodging? And now I'm starting to sound like Patrick Francie, but this kind of shit just drives me crazy because this is really, this was a good product, and these short-term rentals filled a void in the marketplace. That's why people use them, and it drives me crazy when any institution comes in and tries to regulate that. Let the market do what the market does best and sort itself out. That's my opinion.
Well, 100%. And I think that you look at what the impact of that is. When you look at short-term rentals, number one, the travel industry has changed overall. Flights are full. There's less flights. I mean, when we look at what's happening in the travel industry, people are trying to stay more provincial, more local, if you will. And even if people who are coming in, they're looking for short-term rentals. Again, it's about what kind of accommodations do you want for a family of 4, 5, 6, whatever that might be. They want to hang out. They want to cook their own meals, and or they want a place to hang out and watch television together as a family. Hard to do in a hotel room with 2 queen beds in it. So it's a real shift of what they're asking tourists to do, and I think it's going to be costly in a lot of these towns. It's going to be interesting to see what happens over the next year, and like everything, it will take a long time to work through the system. And ultimately, there'll be a lot of pain in between for those individuals. You can't deny how many people were buying short-term rental investments when that was the only strategy they had. Now they're going to be, I can't make money long-term. I got to sell. They're going to sell at losses. Maybe the market's going to get soft.
They're going to have to, Patrick. They're going to have to sell at a loss because there aren't that many options. The lender really doesn't care. The bank that finances this acquisition really doesn't care what you do with the property. All they want is their interest payments. I got a phone call, literally, I'm not kidding you. I got a phone call 1 hour before we started recording this. Somebody called and wanted us to manage their short-term rentals because that's at Vistra Property Management. We do property management, but we don't do short-term rentals at all because it's not the game we play. But this person called me, Patrick, and get this. They said, how much can I rent this unit for? So my leasing team told them, well, you should be able to get, if it's a duplex, you'll get this, and how many bedrooms and so on and so forth. They said this, and I quote,
My mortgage is $7,000 a month. My mortgage.
So there's no rental unless this is a multifamily with 4, 5, or 6 units that you're going to cover that amount of rent in order to pay the operating expenses and pay the debt on that. There is no option. That person will have to sell. Otherwise, what are they going to do? So this short-term rental story is not over, Patrick. I think it's going to get very, very messy. And I encourage short-term rentals. Now I'm really sounding like Patrick, but I encourage these short-term rental owners to call their government officials and fight this shit, because I think we have to, and that's the other thing is people, Patrick, often take these kinds of regulatory changes laying down. But if you call your local representative, whoever that is, and you make your voices heard, sometimes it does make a difference. I know I've done it, and I've been surprised by the reaction of them. They often take it very, very seriously.
Yeah, well, the only thing in this particular case in British Columbia is the provincial government has said it and made it very, very clear. Municipalities cannot change the rules. Yeah. That's it.
I would still call. I'd still fight my case.
Oh, for sure. Complain. Squeaky wheel gets the grease. That's what we know about what's happening these days.
Now, Patrick, I've been actually waiting for you to bring up Alberta. You haven't brought it up once. I even had my cowboy hat ready to go, all right? Ready to go for when you talked about Alberta, Mr. Alberta. This is the first episode where we've been recording for almost 1 hour, 59 minutes, and 50 seconds, and you have not mentioned Alberta once. So I'm a little concerned. If you're feeling okay, we'll get back to that in a second. But I had to wear my cowboy hat. So, yes. I had to make that very well known. But this is an interesting statistic, Patrick, and I'm sure we'll get some Alberta news in a second, but this is very interesting. You talked about this a little while ago. Some stats are starting to come out on this where student permits, and there's a huge shift happening in international student applications. And this has been fueling a big part of immigration has been students. And this is really starting to dry up in a big, big way, Patrick.
Well, I think there was a shift, number one, just in the number of applications coming in because of the cost. I mean, the news is out. Canada is not an inexpensive place to get an education. You've got nowhere to live. And so that news is out there. So that had already started the drop in the applications for students coming in, international students coming in. The federal government put their change in, at the end of the day, what we'll see is the federal government will take credit for it all. But the reality of it is that applications were already decelerating because of the word out in the world is that Canada is not inexpensive to get an education and there's no place to live. So the applications were already dropping. And then again, the federal government said, okay, we're going to touch the brake on who we let in. And then ultimately it's come off the cliff.
Now, Patrick, we just did a segment recently about short-term rentals and how we warned people not to get into real estate where short-term rental was the only option. And I want to issue a new warning to people about being careful to buy properties where your only option is student rentals. You see what's happening. I'm not saying student rentals are going to fall off a cliff, but be careful, Patrick, is the warning I issue to investors. And do not just buy a real estate property that the only option for that property is a student rental. And if you can't do a student rental, then the whole thing falls apart. If you do that right now with these numbers in front of you, you're playing a risky game, in my opinion.
No, I agree 100%. We say it all the time. Always have, if your plan A is this, make sure you have a plan B, even a plan C, so that you know that you can, in fact, carry the load and keep this property working, treat it like a business. That's always the message that we get out there.
All right, Patrick, now that I have my Alberta hat on, I feel like we need to talk about Alberta a little bit. And that is, this is interesting, which is headline inflation in Alberta is outpacing the rest of Canada. You can see Canada's on its way down, Alberta's on its way up. Eesh, this isn't good for Alberta, Patrick. What's going to happen here?
Well, it's not surprising that we're seeing a little bit of an uptick in inflation in Alberta. Now, having said all that, it's still ridiculously inexpensive relative to much of the rest of Canada, Ontario, British Columbia being the bigger populations. But ultimately, it's if it goes up 3% of 100 versus 3% of 30. Alberta was already historically low. They complain about gas prices hitting $1.25, and at that time, in British Columbia, we're paying $1.75. So the reality of it is that yes, we see a 3.4%, and say Alberta's inflation is a little bit higher, but we're actually higher on top of lower numbers. So ultimately, yeah, it's a concern. You're going to see inflation. You can't help it given the number of people that are actually moving into that province and the demand and all of the rest of it that is part of driving inflation. So is it not good news? Yeah, it's not good news. But when you compare it to what's happening across the country, it's still very, very inexpensive in Alberta.
All I got to say is I'm sure glad I bought my cowboy hat last year before inflation kicked in Alberta. I would have paid so much more for this. Anyways, here's another one, Patrick, is we're starting to see quite a few headlines around increasing rents, the price of real estate. I mean, in Alberta's world, Alberta's so expensive right now. A lot of people feel like, oh my gosh, it's getting crazy. Rent's getting crazy. Prices of real estate is getting crazy because often people within Alberta only look at, within Alberta. When you in your world and in our world as investors, we compare Alberta to the outside world and it's really, really cheap. But they don't view it that way, do they, Patrick?
Well, most people, for me, for example, I'm kind of bi-provincial. I spend a lot of time in both Alberta and British Columbia. I have businesses in Alberta, so I'm there all the time. I see what's going on. I actually see what's happening within my own businesses and operating costs and all of the rest of it. The point is that when we look at the outside of the province of Alberta, Alberta's still very, very inexpensive. But if you're living in it, it only seems like things are getting more expensive. Now, interesting that we're starting to see the trend of rents continue to rise again relative to what's happening across the country, still quite inexpensive. But it was interesting to see that Edmonton has actually seen some pretty meaningful rent increases, which is good news because if you're an investor in Edmonton, you haven't seen these increases for a number of years.
Yeah, you've always said, Patrick, that Edmonton lags Edmonton lags Calgary by I forget how many months you typically said, and so far Edmonton has broken that track record in the last kind of 6 months. But maybe it's been a lag effect. Maybe now it's going to start happening.
I don't think so. It's generally 18 months to 2 years, and I think the trend is broken. I actually have made that statement. I tweeted it out when I looked at the trend that I'm starting to see unfold between Calgary and Edmonton. Edmonton is staying flat. Calgary continue to increase, but I'm seeing Edmonton actually trend a different direction, stay flat. I don't think Edmonton's going to follow Calgary's lead like it has historically. I think that's political. And, ultimately what's happening in Edmonton versus Calgary. And we also see what's happening around Edmonton back to what was happening in Fort McMurray, Grand Prairie, some of these other regions that were driving that demand in Edmonton. That's settled down or slowed down, if you will. I just don't see Edmonton having that growth. And by the way, I'm selling a property. I'm going to be selling 2 properties in 2024 in Edmonton, and I'm going to let you know how that all goes.
There you go, folks. You heard it here first. If you want to buy some properties at a fire sale, just leave a comment below. Patrick will sell it right here on YouTube. Um, but Patrick, let me give you a little red meat on this. And I know we're going a little long, but I think it's and maybe for another episode. But do you think this has to do with Edmonton and their 15-minute city, and they're pushing that agenda forward? Do you think that has something to do with this?
Well, we've never had a 15-minute city before. So, I think there's a lot of uncertainty. I think people, when you look at the NDP government, is a very socialist government in a blue collar town. It's a government town. I think investors and those individuals who are wanting to put investment capital somewhere going, it's just too messy in here. It's too confusing. Where do I invest in Edmonton? Given that they're moving forward aggressively with the 15-minute city. Well, what does that even mean? And how is that going to impact my property if I'm in a particular sector of the city? So I think there's a lot of confusion and a lot of uncertainty. We've never dealt with 15-minute cities before. There's very little, I guess, comparison. In the UK, they've got it, and they're starting to. I don't know what it's going to all mean, to be honest with you. I'm kind of like everybody else. I'm going, what could this mean? I try and extrapolate, but I don't know the answer.
Interesting. More on that, I'm sure, in another episode, Patrick, because it's definitely a fascinating, development that's happening in some cities, not all of Canada, but in some select cities. What other cities, Patrick, do you know off the top of your head, what other cities have elected to go down this 15-minute city road?
I did know. I don't know off the top of my head. I want to say Abbotsford, but I don't know that to be true. So Edmonton for sure, because they put it out there.
So Patrick, that means that two of the cities that you are closely tied to will go 15-minute city. I'm starting to think this has to do with you. Maybe that's where this all started. Maybe you're the start.
I'm not even sure about Abbotsford. It was just popped into my head. I did know the answer to that question. I just don't have it off the top of my head right now.
Awesome. All right, folks, hopefully you've enjoyed episode number 33 of Rein It In. Thank you so much for watching. Please like, subscribe, comment. We'll see you on the next episode.
Thanks, JG. If you like what you learned here, go to the description below and subscribe for our free Insiders newsletter, where you can also stay up to date for our upcoming events and our courses.
If you want to see more stuff like this, click there.